A few weeks ago, I made a video warning you about Netflix. I looked at the chart and I told you that the company was about to make a massive mistake. They were in a bidding war to buy Warner Brothers. And I warned that the $82 billion price tag, the massive integration risk, and the heavy debt load could destroy shareholder value. Well, it seems Netflix management agreed. On Friday, they announced they are walking away from the deal. They refused to overpay. And the market loved it. The stock jumped over 20% in just a few days, adding billions to its market cap. Investors are looking at the headlines and they are relieved. They see management acting with extreme financial discipline. And the narrative on Wall Street is starting to turn incredibly bullish. They are saying Netflix just dodged a bullet. I completely agree. And in my opinion, Netflix has come as the winner of this whole bidding war story. I believe the market is making the right call. They are looking at the fundamentals and they realize that Netflix is now a cash flow machine. In this video, I want to step away from the media headlines and look at the actual numbers. I will show you exactly how this no deal impacts their financial statements and why it makes Netflix one of the most interesting stocks of 2026. First, welcome back to Rebuild Finance. This channel is about documenting a long-term investing journey, building a portfolio over time, and sharing my thinking. My goal is simple: find elite businesses, buy them at fair prices, and hold them for the long run. And right now, the discipline shown by Netflix is creating a fascinating case study. Before diving into the financial statements, we need to understand why walking away from Warner Brothers was such a pivotal moment. For months, Wall Street thought Netflix needed to buy a legacy studio to secure its future. The narrative was that Netflix needed to own century-old intellectual property, like Harry Potter or Batman, to survive. But when Paramount offered $31 a share for Warner Brothers, Netflix looked at the math. If Netflix had bought Warner, the financial impact would have been brutal. They would have inherited roughly $15 billion of Warner's existing net debt, and they would have needed to issue massive amounts of new debt just to fund the deal. Moreover, they would have inherited the declining margin, low growth cable networks, and faced years of regulatory battles with the government. By walking away, they dodged a massive bullet. They avoided the debt, they avoided the distraction, and while competitors are spending billions to merge with each other, Netflix is focusing on what it does best. In my view, this was not a missed opportunity. It was a strong example of disciplined capital allocation. Now, let's look at the financial impact of this decision. We are going to break down the balance sheet, the cash flow statement, and the income statement. Let's start with the balance sheet. This is exactly why the market cheered the announcement on Friday. When you make a massive acquisition, the balance sheet takes the first hit. If you look at Netflix's balance sheet at the end of 2025, they had an overall cash position of roughly $9 billion. This figure is nowhere near the $82 billion price tag required for the acquisition of Warner Brothers. If the deal had gone through, Netflix would have had to issue tens of billions in new debt to fund the transaction. In a world where interest rates are still elevated, that debt becomes a heavy anchor. This acquisition would have had multiple devastating effects on Netflix's balance sheet. The first one, as I just highlighted, is that it would have significantly increased their current $13 billion long-term debt load. The second one is that they would have added massive amounts of goodwill and intangible assets to their books. This creates the risk of multi-billion dollar write-downs in the future if the integration fails. By saying no, Netflix kept its balance sheet pristine. They remain an investment-grade tech company. They do not have the bloated, complex balance sheet of a legacy media conglomerate. This financial flexibility allows them to weather economic downturns far better than their highly leveraged competitors. And as we will see through the cash flow and income statements, the long-term debt they currently hold is easily manageable for the company. Next, let's look at the cash flow statement. This is the real engine of the company. For years, people criticized Netflix for burning cash to fund their content treadmill. Those days are officially over. Netflix is now a free cash flow machine. They are generating billions of dollars in positive cash flow every single year. Look at the image. In 2024, they were able to generate $7.3 billion in operating cash flow. In 2025, this figure increased to over 10.1 billion. And look at the free cash flow. It also increased significantly, jumping from almost 7 billion in 2024 to nearly 9.5 billion in 2025. This massive capacity to generate cash would have helped Netflix repay the huge loans needed for the acquisition. But since they walked away, they now have real optionality with the free cash flow they are generating. What will they do with that cash? First, as described in their latest letter to shareholders, they will reinvest roughly $20 billion this year in organic content. But more importantly, they are pivoting hard into live sports. They have secured deals for WWE Raw and NFL games. These live events bring massive viewership and allow Netflix to charge a premium to advertisers. Second, they can now service and repay their existing long-term debt without any issues. Third, without the heavy burden of an acquisition, they can use their excess cash to aggressively buy back their own stock. This directly rewards existing shareholders and boosts earnings per share. Thus, by choosing not to pursue the acquisition, the management of Netflix chose internal compounding over expensive empire building. Now, let's turn to the income statement, where we see their massive scale and pricing power. As you can see on the screen, from 2023 to 2025, Netflix's revenue grew at a double-digit rate each year, roughly 15% to be exact. And in 2025, they generated a massive $45.1 billion in revenue. The costs associated with those revenues did increase year by year. However, the percentage increase in cost was lower than the percentage increase in revenue. Because of this dynamic, the gross margin increased dramatically, jumping from 41.5% in 2023 to 48.5% in 2025. These concrete numbers perfectly illustrate the strength of Netflix's operating leverage. In a digital business, once you cover your fixed costs, like the server infrastructure and the initial production of a TV show, every new subscriber you add drops pure profit to the bottom line. And speaking of new subscribers, in January 2026, Netflix released its shareholder letter and dropped a massive number. They officially crossed 325 million paying subscribers globally. If you assume 2 or 3 people share a household, Netflix is regularly watched by almost 1 billion people. No other platform comes close to this distribution scale. By walking away from the Warner Brothers deal, Netflix protected this incredibly profitable engine. Without the dead weight and lower margins of Warner's legacy television networks, Netflix shields its profitability. Moreover, because they are the default entertainment app in millions of homes, they have immense pricing power. They can slowly raise prices, and people simply accept it. This kind of dependency creates a powerful long-term tailwind. And, as highlighted previously, with their new advertising tier growing rapidly, they have unlocked a completely new, high-margin revenue stream. So, the balance sheet is clean, the cash flow is strong, and the margins are expanding. But what about the valuation? Quality comes at a price, and Netflix is not cheap. After the recent price jump, the stock is trading at a trailing PE of roughly 38 and a forward PE ratio of around 30. If you compare this to Netflix's historical PE ratio, this valuation is not actually bad, especially considering they are a market leader still growing revenues at a double-digit rate. Now, a 30 forward PE might sound high if you compare it to a traditional media company like Disney. However, the market is no longer treating Netflix as a traditional media company. It is pricing it as a tech monopoly. Compare that 30 PE to other big tech companies that dominate their respective industries, and the valuation seems completely in line with its peers. Actually, when you factor in their double-digit revenue growth and their expanding operating margins, the premium valuation starts to make perfect sense. Is it a deep value play? No. But is it a fair price for an elite business that just proved it has unmatched financial discipline? I believe so. To summarize, the market is buying Netflix because investors are relieved. Management proved they will not destroy the balance sheet with a massive, risky acquisition. I believe that in 5 years, we may look back at this no deal decision as a defining moment in Netflix's long term positioning. Personally, I bought only small quantities of the stock a few weeks ago around the $75 and $80 levels because I was terrified of the Warner Brothers acquisition. I thought that if the deal went through, the stock would suffer for years. But now that the binary risk is gone, my perspective has changed. I will continue to add to my position in the coming months. I think that today, Netflix is incredibly well positioned for the future. Some might argue that Netflix faces an existential threat from AI and its capacity to generate long form video content. However, I completely disagree. Netflix has proven it is highly capable of creating incredible, culturally relevant series that keep people locked to their screens. And I do not think AI will be able to disrupt that kind of human storytelling anytime soon. But what about you? Do you think walking away was a genius financial move, or do you think they will regret not buying Superman and Harry Potter? Let me know in the comments. If you found this financial breakdown helpful, please hit that like button, drop a comment below, and tell me which company I should analyze next. If you want to follow my journey building a portfolio to $1 million, make sure you subscribe. And if you want to know what happened to my Amazon analysis and why I am so bullish on their AI infrastructure, make sure to watch this video right here. Thanks for watching, and I will see you in the next one.